Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday, the 24th of September 2022. We're publishing our Gold and Silver Weekly Update for the week ending the 23rd of September. Now, before we do that, we have an important announcement at the end of this video. So please make sure that you tune in to that announcement, or alternatively skip forward towards the end of this video. Let's take a look at what's happened this past week. Looking at precious metals first, we can see that gold fell $30 last week, falling from $1,676 to $1,644, having hit a high of $1,688 and a low of $1,640. That's a fall of 1.8%. However, because of the strength of the dollar and the weakness of sterling, gold actually ended up £50 at £1,517. And in euros, it also closed up some 24 euros, not as much as sterling, at 1,698 euros. Silver, however, fell 75 cents, falling from $19.64 to $18.89, having hit a high of $19.92 and a low of $18.79, a fall of 3.8%. Now, in sterling terms, silver closed at £17.42, that's up 24 pence, and in euros it closed at 19.50 euros, that's down 0.11 euros. Obviously, as a result of this, the gold to silver ratio rose, and it rose from 85.3 to 1 to 87 to 1. Now, looking at the predictions we made last week, we said we're lowering our expectations for gold and expect to see it trade between $1,600 and $1,725, and we forecast silver to trade between $18 and $20. Both gold and silver traded within our predicted normal trading range. Perhaps one could argue that to some degree, the surprise, if there was one, was the fact that the spreads were smaller than many of us anticipated, with the difference between gold's high and low being just $48 compared with the previous week's $81, and silver's spread being $1.13 compared with the previous week's $1.22. So clearly a lot of the movement in gold and silver had occurred the week prior. Now, in view of the fact that we had the FOMC decision, we did expect more volatility than what we got. But we shall cover this in a moment after we look at the other financials. Bitcoin currently stands at $19,075. That's down $775 on the week, though it had been quite a few more $100 down earlier today and Friday. Equities were down quite significantly this past week again. The Dow Jones closed on Friday at 29,590, down 486 points on the day, and down 1,232 on the week. The S&P closed down 64 points at 3,693, and the Nasdaq Composite closed at 10,867. That's down 581 points on the week. Oils were lower again this week. Why? Because of the strength of the dollar, which we'll look at also in a moment. Brent crude closed at $86.15. That's down quite a sizable $5.20. And WTI crude closed at $78.74, down $6.37 on the week. Now wait for this. The dollar index stands at a whopping 113.19. And that is up 3.43 points on the week. Let's now take a quick look at the economic data announced last week, that's just gone, and the important, in fact very important data to be announced this coming week, which really is next Friday's. Well, as we stated last week, all eyes were really on Wednesday. Now, before we look at that, just very quickly, we can see that on Monday and Tuesday, it was essentially related to home building permits and housing starts, and they were broadly, not exactly, but broadly in line with median forecasts. Then on Wednesday, we had existing home sales, which were slightly higher than anticipated, and then the Federal Reserve statement, where they raised interest rates, as we predicted, by 0.75%. Many people thought that they would rise by a full 1%. We felt it would be advisable to raise that by 1%, and then because there is no meeting next month, they might only have to raise it by a lower amount in November or December and December. But they decided to err on the side of caution and raise rates by 0.75%, meaning that the Fed funds rate now is 3% to 3.25. We certainly see this going up another 1% no later than the end of January, and suspect that we may have a November rise of 0.5% and then possibly a December rise of a similar amount, or they might wait until January and bring that rise in then. We shall wait and see, but we are anticipating for sure 4%, but so much is dictated by other economic data. Jobless claims broadly as anticipated. Continuing jobless claims marginally down by 0.02 million. Current account deficit as a percentage of GDP for Q2 is down 4%, and leading economic indicators worse than anticipated but better than the previous month. Now the flash PMIs, and we don't place too much emphasis on flash PMIs, but nevertheless the S&P manufacturing index was 51.8, marginally above expectations and August figures, and the services PMI is reasonably larger than both envisaged or anticipated figures and August figures. Now, this coming week, on Monday, we have really more commentary by Fed officials than any actual real data, apart from the Chicago Fed National Activity Index. Then on Tuesday, we have durable goods orders, core capital goods orders, various home price indices, but perhaps the one we would look at more closely on Tuesday will be the Consumer Confidence Index. Then on Wednesday, we have, again, more comments made, and Fed Chair Jerome Powell will make a comment. Basically, there will be a lot of attention paid to that. Thursday, jobless claims and various income and product revisions. And then on Friday, this is the key date for next week, the Pce Price Index. So you've got the core and the index year on year. We have real consumer spending and disposable incomes, and we have the UMich consumer sentiment and the 5-year expected inflation rate. But it's going to be the PCE data that's going to be looked at most closely. And once again, if that is higher than anticipated, then the dollar will just go from strength to strength. Though we do think, quite frankly, it's a little bit on the high side right now. There is absolutely no doubt that precious metal prices, as well as other commodities such as oil, were hit by the surge in the dollar index. We certainly expected it to rise to 111 and thought 112 was indeed possible, but 113 is really off the charts, and we are expecting it to correct at some stage, though it could potentially still go higher, and 115 is not an impossible tally. Though, frankly, we're waiting for other central banks to amend their interest rate positions. Of course, if they do so but are not as aggressive as the Fed, then the dollar index will rise further or at least remain high for some considerable time. The PCE data, which is what we are going to watch out for next Friday, will also have, in our view, quite an impact on what's going to happen to the dollar index. Now, we stated last week we're still not bullish precious metals, taking the next 3 months into account. Too many headwinds to see any major spike in prices. Chartists or technical traders are now rather despondent gold and silver prices and expect to see gold eventually decline to $1,500. And we can also see that occurring in the months to come. Some have suggested as low as 1200, but our calculations are not showing that at present. Though, again, cannot be ruled out. A lot really does depend on how inflation remains so elevated. And the more elevated and the longer period it remains, the more hawkish the Fed has to become. So the wide sort of technical range, at least for now for gold, is running between $1,500 and $1,700. Silver is also in decline, and once $18 is breached towards the downside, we can see silver trend towards the $15 level. Not in one jump, but over a period of weeks. Especially if recession is on the cards, or a global recession is on the cards. There will undoubtedly be a slowdown in growth as rates are raised, and the question many analysts are asking behind closed doors is, can we actually see silver dip to as low as $12 again? Now, if it does, we shall be buying. Let's make no bones about that. We will be buying at $12, as we did the last time, though not enough. Now, we're skeptical at this stage that $12 will be reached, but again, nothing can be ruled out. To the upside, silver has to move decidedly above $20 and hit that $21 level before we would give a change of trend. So with this in mind, and we want to keep today's video as short as possible, we expect to see gold trade between $1,575 and $1,675, though we suspect it'll be in the 1600s in the main, with $1,550 to $1,725 as outliers. We forecast silver will trade broadly between $17.75 and $19.75, though we're expecting the lower end of the scale, with $17.25 to $20.25 as outliers. What do you think? Please share your thoughts on this. Now, we mentioned at the start of this video there is a special announcement, and we are going to produce 1 or 2 videos this coming week about some changes to this channel. We have had it indirectly confirmed that our channel is not being promoted by YouTube, primarily because of the name. So we are looking to change the name of the channel, and also looking at how we are going to cover future videos, which the plan at this stage is to be in person, where you can actually see me, the presenter, Richard, actually on screen. Now, that may frighten some of you, no doubt, but we're very, very conscious that the numbers are falling. Perhaps it's because people are finding it boring, not interested, or we know for sure we are not being promoted by the back office details by YouTube. And it's been sort of suggested to us by experts that the name is what's putting people off. What will it change to? Give us some suggestions. We're open, obviously, to thoughts and ideas. Meanwhile, thank you for listening. If you haven't done so, please subscribe to the channel, especially if we are going to change and become more lively and personal. And if you haven't done so, press that bell sign too. Thank you so much. Have a great weekend. Prosperous week ahead, and we'll repeat this video tomorrow under a different headline and thumbnail. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.